Welcome to TheoTrade. This is Don Kaufman. It's August 10th, 2017. Seeing some fairly serious volatility in the markets in today's session. But first, we are opening up a couple of seats back to the early bird pricing due to the fact that we just took on TD Ameritrade as a sponsor for our live Scottsdale event. That's TheoTrade Scottsdale Traders Retreat Extravaganza. It's going to be myself, Doc Severson, Jeff Bierman, Tony Rago. We're going to be kicking it off on Thursday evening, September 7th, 7 to 9. We've got a full day on Friday, September 8th from 9 a.m. to 5 p.m. We've got full session on Saturday from 9 a.m. to 5 p.m., including cocktails again on Thursday night. Some of the sessions, of course, include, again, myself, Doc Severson, Jeff Bierman. We're going to be talking from quants to charts over here, building a better market bias, a fractal analysis intensive, learning some of the nuances of constructing kind of the perfect trading plan. I'm going to be talking extensively about volatility, Tony Rago, and he's going to be discussing, of course, Nasdaq and intraday trading style. Again, getting your hedge on, risk management 501, and really volatility trading at the extremes, which is precisely the discussion for today's evening video. Take a look at this. Again, it's theotrade.com/live, theotrade.com/live. I want to thank TD Ameritrade as coming on as a sponsor for our TheoTrade event. It has now allowed us to open up a couple more early bird seats over here. It's $1,000 for the full event. We're running out of hotel rooms, so please book now, theotrade.com/live. Now, let's get to some of the market action. All right, where to begin? We got some volatility in today's market action. First and foremost, S&Ps right now, where are they? Down 35 handles. Of course, that's 35 points with just about 5 minutes to go to the closing bell. Nasdaq futures are down about 130. What are you looking at right now on your screen? Well, when we're in the midst of some volatility, one of the, I think, the most important things to discuss right up front are levels. For that, we're going to look initially at a 90-day, this is an S&P futures chart. Now, you may not trade S&P futures. That's neither here nor there. The S&P futures drive order flow to the marketplace. So whether you're looking for S&P futures, the SPX, the spiders, even Apple, all of this order flow is being driven, of course, by the S&P futures. So I start with an S&P chart, 90-day, 2-hour. All I want you to do is to look at some very specific levels. First and foremost, we come to the level of 2438. Now, this is not a level that we just put in place in the last couple of days. In fact, these levels have been there for months, and you can see that the level I've got marked on the screen. Again, you can mark it on your own screen over here. It's 2438. That's exactly where the market is trading right now. The level down below, and we'll come to that momentarily here, is approximately 2411. This happened to be, okay, a channel that we were pinging back and forth. Now, again, as I said, these are not levels we just, pulled out of thin air today. This is a level that you can see, and specifically if you're on thinkorswim, you can right click, go in here to edit properties. You can see we labeled it on June 26th of this year. Okay, so I'll close that up. Down below that, okay, we've got what? 2411, and that was marked back on May 30th. So I'll cancel out of there. Now, this is critical as we're coming into the close. We're closing on a key risk inflection point, closing below it. And again, you're in the midst of volatility. You're like, why are you talking about levels? Because when you're seeing volatile trade, levels is really all that you have to go on. If you ask me like, oh, we're going to flip around back tomorrow, we're going to head back down tomorrow, what are you thinking over here? And the answer to that is pay attention to the levels, okay? If we get below, and I want to make this abundantly clear, in fact, I'm even going to come into an intraday one-day chart. If we come below this 3438, all right, and really push off it a little bit, we start getting down to this 2434 and so forth, and we start to push again below the 38 level, it's dangerous. At that point, I believe it's a straight shot, okay, right directly into this 2411. Below 2411 obviously is 2400, neither here nor there right now. But again, if we kind of continue to drop, just a hair below where we are, even in the overnight session tonight, we could actually push all the way into 2411. I know that seems like a fairly, precipitous drop, even after the fact that we're down almost 40 handles in the S&Ps today, okay? But the truth of the matter is, if you look back at any of the recent trade that we've had, and again, I'll deviate once again, I'll go to 90-day, 2-hour, you'll see precisely that type of action in the midst of any volatility, which has been very, very limited in recent months, right? But in the midst of any volatility out there, we have shot right back down to this 2411 and ultimately bounced off of it, okay? At this point, look at the 2438 is kind of like your life, like saving, level over there. That cracking below it, assume that we're going to be a straight shot to 2411. And again, that's where I really wanted to start in the midst of this volatility here. When the VIX starts getting heated, you can't grip on to volatility and say like, well, I think volatility is going to do this. Volatility overreacts, okay? Volatility is like one of the most schizophrenic products that you can possibly be involved in, and it overreacts when markets start to get a little crazy out there. Now, me personally, I live for these days. These are the days I'm not putting any positions on right now. I'm taking positions off. I'm fairly bearish. Now, let's kind of continue on and look down the screen and let's see what damage has been done. Overall, I know we're looking at this, we're closing right smack into the lows. And the irony is, and I really wanted to record this because the closing bell is coming right here, right now, right? The irony of this is we're actually teasing because we're literally 1.5 points off this 38 level, which makes us really dangerous again in the overnight trade. I actually think here in just, by the way, the futures, they're going to be open for another 15 minutes. There we go. I think we're going to pop right back into 2438, and that's exactly what we're doing. So we're going to sit here at this point. Tomorrow, assuming that we're going to sit here throughout the course tonight, meander right around 2438 because that is the level, okay, tomorrow's cash open becomes very, very dicey. Now, again, there's no predictability to geopolitical, risk out there. There's none. Like if there could be a war in the middle of the night. Listen, you got to throw that out. The markets are already pricing in a fairly high degree of risk. What do I mean by that? Well, let's go look at precisely what we looked at last night, which was the VVIX, the volatility of the volatility index. The volatility of the volatility index. I'm going to bring up the last 3 years. This is a 3-year daily. Okay. We are now hitting extreme levels on the VVIX. This is get under your desk, duck cover. The problem with the VVIX, as high as it currently is, you have to recognize, okay, and all this basically means, again, I'll make this clear if you missed last night's, discussion that we did here in the TheoTrade video, but all that VVIX is doing is it's displaying funds out there, are they scared? Are big money managers scared? Because big money managers, again, I mentioned this exact analogy. If you have $7 billion, okay, of capital in equity markets, you can't exactly just, hey, I'm going to go to cash. You can't take $7 billion out of the marketplace. So what they do to hedge is they run and they start buying options specifically in the VIX, okay? And today, they were buying options in the VIX. The VIX actually traded almost 5 million contracts, which is very close to 3 times its normal trading volume versus the previous 5 days. For the most part, it traded huge volume inside of the VIX. There's no surprise there. So the issue is with the VVIX as high as it is, and it's up there right now, okay? You look at this point at the S&P futures and realize, like, really? The damage done right now is a whopping 35 points. And that should sound minuscule to you. That should almost sound like a joke. You should be laughing and being like, oh, wow, whoa, the VVIX is what? Okay? It's one of the highest readings that we've seen anytime in the last 3 years. The only thing higher, really higher than this, okay, was back in August of 2015. It's August 2015 when the market literally crashed at the open by 7% and then rallied back up. You got lucky, okay? There's been a couple of peaks, a couple of valleys here. Each one of these, though, has been met with wild selling. I'm talking like if you look here in December, okay, in December of 2014, this is before the S&Ps dipped all the way down to 1800. That's right, the S&Ps were down at 1800, right in this neighborhood down here. And I was reminding everybody of that. So once we see the VVIX as high as it is, you don't have to look at it anymore. Believe me, okay, risk is here. That's what the market is ultimately screaming right now. Now, let's look at some of the damage that was done today, specifically in products like the XLF. The XLF, the financials. Why do I keep keying into the financials over here? I must stress to you time and again, this is what's driving the S&Ps. It's not so much Apple. Sure, Apple got socked today by about 3.6%. Okay, that's Captain Obvious kind of stuff. Who cares? It's the XLF, the entire financial sector fell. And even if technology sold off, if the financial sector doesn't move with it, we're not going down. So the financials coming down by about, 1 3/4 points over here. It's big. But, again, zoomed out to the bigger picture over here. What's the bigger picture? Look where we've come from. And by that, here, let's just zoom out for a second to like a 1 year. And we're from basically 20 to a straight shot almost to 25 with little hindrance over here. Damage will truly be done. And today, this is like, running through a field, falling and like skinning your knee today. That's it. Not just in the XLF, but the entire marketplace. That's all it did. Call me and tell me when the XLF starts to crack into the 23 range, then some extreme and very serious damage would be done to the marketplace. If anything, today's move was very, very orderly, okay? Now, what everybody's thinking, okay? We're coming into Friday. Are we going to bounce? Let's talk about the possibility of a bounce over here. Here's possibility and here's the reality. First and foremost, the reality, this is the expected move for the week. Now, the week started out, okay, about as docile as it could possibly be. If you remember my Monday video, it was the lowest volume basically we had done outside of like Christmas, half a day, kind of Christmas Eve. Ultimately, what we've now done is we were sitting right around a $22 expected move. Well, newsflash, we cracked it, okay? We cracked it, and the expected move, the edge of it, was 24.53. 24.53. Now, that was according to the SPX. The only question to ask for tomorrow's trading session, do you revert right back up to it? Because let me actually show you what it looked like today. You think the expected move doesn't matter? It flirted with it. It flirted with it. It finally cracks through it. It flirts back into the expected move, and then we were just a straight shot of dynamic hedging down. The real question that looms over here for tomorrow's trading session, and this is really, really relevant right now, pay close attention. We're on the edge of exploding into a 3 sigma move. What a 3 sigma move would mean. Well, we started the week out here right at the 77 level, okay? And we had about a $22 expected move. So some quick dirty math over here. It's about a $22 expected move, right? That's where the week ultimately started there. What a 3 sigma move entails is 3 standard deviations. So instead of moving $22, it's 22 times 3. So you'd look at like a 66-point move outside, okay? It's, again, a very, very large move outside of what was expected. $22 move is expected. We could see a 66-point move. It doesn't mean that the S&Ps have to move down 66 points, okay? What it ultimately means is from this price point of about $24.77, just subtract about $66 from it. What do you come down to? $24.11. You can't even make this crap up. That's 2411 though in the SPX. That would actually take us pretty close though to the 2411 inside of the S&P futures. It's some scary crap that you better consider, all right, in this evening's trade. Could we bounce back up? Yes. But right now, there's a little bit of blood out there on the streets, and there hasn't really been any sell-side activity. And again, I'm looking at the S&Ps. You'll notice that I kind of scraped over the Nasdaq a little bit today. The Nasdaq, again, took it on the chin by about 2%. But people, perspective here, we haven't even hit any statistically significant moves. We haven't seen a 3% move in any of the major indices on a one-day basis. That's the kind of move that you need to see. Like if you think this is going to be a one-day capitulation and rally back up, that's all fine and dandy, okay? But if this is going to turn into real sell-side activity, you better start looking for 3% moves on a daily basis inside of a major indice. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.